Hey everyone, this will be a quick one where we talk about some preferred shares and how I like to think about them. And this isn't a recommendation to buy or sell. This is just me talking about how I look at the process and what I like to look at when I look at these things. So I think I can make more money on owning the common stock than owning preferred shares, but sometimes you see preferred shares and they're pretty cheap, and then they start to look attractive, especially if you use your retirement accounts instead of your taxable accounts. And why is that? So you've got your regular brokerage account, let's say, and you've got a traditional IRA and a Roth IRA. So a traditional account, if you get dividends, generally those are taxed at a lower rate than what your income tax would be. So if you pay income tax on the first, I don't know, 30,000 at 15%, and then as you go higher, it's 20%, 30%. And if you get qualified dividends, they are lower than that. I think they're like 20%. So if you would put them in your traditional brokerage account, you pay 20%. What if you put them in an IRA? Well, you get a tax deduction when you put money in the IRA, but it's taxed at the highest tax rate when you pull it out. So if you got a 10% dividend in your traditional IRA, it would be taxed higher than it would be in your brokerage account, because your brokerage account that's taxable, you're getting charged that 20%, but in your IRA, because it's taxed at your highest tax rate, if you're in the 35% tax bracket, it would be taxed at 35%. So what about the Roth IRA? Well, you don't get any deduction for putting money into your Roth IRA because they're after-tax dollars, just like the after-tax dollars that you would use to put in your traditional brokerage account. However, everything in your Roth IRA is 100% tax-free. So if you put it in your traditional brokerage and you got a $100 dividend, you would get to keep 80 of that because 20% is taxable. Don't quote me on the tax rate. I don't know what they are, but just for illustrative purposes. So on that 100 in your traditional brokerage, you would get to keep 20. If you put it in a traditional IRA, you got $100. They take out 35% tax. So from that 100 in the traditional brokerage, you get to keep 80. From that 100 in your traditional IRA, you get to keep 65. But if you put it in a Roth IRA, from that 100, you get to keep all of it, $100. So that's great because it would work out to, if you're getting a 10% dividend, it would like trying to find something that pays 12 or 13% in your traditional brokerage, which would be hard to do. So what are preferred shares? Preferred shares, somebody in Wall Street once told me, if you're thinking about equity, common stock, preferred stock is really debt dressed up in drag. So it's called stock, but it's really debt. And what do I mean by that? Well, if the bank lent you money to buy your house and you made a lot of money on your house, the bank can still only get 100 cents on the dollar of what they loaned you. They don't participate in any of the upside, and that's sort of what preferred shares, preferred equity, however you want to describe it, is. It's not quite debt, it's not quite equity. You get a fixed amount, and it's somewhere between debt and equity because it's not secured. So, and they can suspend the dividend under certain conditions, which they can't do if it's debt. So if you owe the bank money, you can't say, hey, I'm not going to pay you for a while. I hope you're okay with that. But there are contractual provisions in the preferred equity where they can stop payments on it if they become in trouble, and there's nothing you can do about it. But if you buy what's known as cumulative preferred, they technically owe you that money, and then they would have to pay that to you as the preferred equity holder before they pay dividends to the common equity holder. So you would be here in the capital stack, and here is the common. So if this is paying, let's say 8%, and this is paying 2%, and then they run into trouble, and then they stop the dividend here, and they stop the dividend here, then before they can pay themselves the 2%, they have to pay you the 8% that they owe you now, plus whatever they owe you before. Whereas if you have the common and they do away with the dividend and then they decide to give it back, they don't ever have to make up the past dividends to you. So what are we looking at here? Here's Seritage Growth. It is a company where the shares of the common were bought several years ago, pre-pandemic, by Warren Buffett, and people got very interested in the company. During the pandemic, it suffered a lot, and now they are in the business of trying to liquidate all their properties before they go bankrupt. But they did have these preferred shares, and they're callable, meaning the company can make you pay them, give them back the shares, and they'll give you back the money you paid at $25 where it was issued. So you're getting it at $22, so you get 10% on top of the dividend if they called it next year, right? So this year, because of where it's trading, you're getting 7.89%, and the difference between 22 and 25, it's a little over 10%, so you get about 18%. So why is this dividend so low? Because at the time it was issued, interest rates were really low, and so even though this is a little cheaper now, you're still not getting a great dividend. And there is a belief that if this company liquidates and they get what they can for their property, that you will get the full 25 cents on the dollar. And so some people would think that this is a good deal. That is the most likely scenario because they have announced that they're selling everything off, and they will try to make not only the preferred shareholders whole, but they think they'll have enough to pay some of the common shareholders, and that's why the common shares are trading at $363 rather than $0. However, there's another option. If you read through the offering prospectus, if somebody else buys this whole company, they buy the common shares, there's a possibility that you would still have the preferred shares, but it would be inside a company that's not publicly traded, and then they can suspend this dividend, and they would still owe it to you. But after 7 or 8 years of not paying the dividend, you might be tempted to sell out at. There's ways that they have to squeeze you. So I don't think this is a great idea. I think rather than buying shares, preferred shares in a company that's liquidating and hoping that you get 100% on the dollar, you're better off looking at a company that's doing really well, and these shares are callable, and they'll give you the offering price, par, $25 a share, and then you can go on your way. So here's one that's like that. LifeMD, which if you know that company, Teladoc, it's much bigger than this. This is a smaller company, but they do kind of the same thing. And these shares are issued at $25 par, and they're technically callable right now. So when they were issued, they were callable at any time at 103% of par, and then I think right now it's callable at 101% of par. So that would be $25.25 if they called it right now. If they call it after October 25 of this year, then it's they would be callable at par. So they would say, give us your shares back, and we will give you $25, and then you'll go on your way. And while you wait, you get this dividend, which is pretty high, 9.5%. And if it's callable at 25, the difference between 22 and 25, it's about 10%. So you get about 10% plus 9.9, you get about 20% if it was called in a year. Will it get called? I don't know. This company is currently not profitable, but they're getting there. So revenue is increasing, profits are increasing, and they're still losing money, but it's one of these things where it has kind of operating leverage. So with a lot of these tech companies, once you break even, it's very easy to sort of make money because a lot of your costs are on the developing the back end and the infrastructure, and once you have that, each customer is profitable. So I have a feeling, and it's just me, once they become profitable, they'll start to look at this as expensive operating costs and might call it in. So currently they're not making money, and they are close to that, but they do give out a lot of stock options, and that costs them a lot of money. So I think once they become profitable, they'll stop issuing stock options and start paying with cash, sorry. And then I think the second best use of cash would be to call these in, and then you would get the difference between this and 25 and this while you wait, if all goes well. And as I said, I think in a company that's going well and has a lot of cash, you have a better chance of getting called and getting 100 cents on the dollar than in a company that's going bankrupt and trying to sell everything off and hoping that you will get paid 100 cents on the dollar, because in terms of the priority, you are here instead of here. So the hope is that after this guy gets 100 cents on the dollar and after this guy gets 100 cents on the dollar, that there'll be some money left over for you. But there's no guarantees of that. So I don't think this is a good risk reward for me for 7.9%. This is a little bit better bet because they're about to be profitable and you're getting 9.9%, and it's technically callable right now, but they're not profitable, so I don't think they'll call it right now. And I do own some of this, and again, this isn't a recommendation to buy or sell. This is just me telling you what I saw in this. And this is, let's see, it's less than 22, so you're getting more than 10%, and because it's beaten down so much, you're getting more than 10% of dividends. So this is callable in, I believe, May of next year at par, which would be $25. So you're getting 20% if it's called next year. Will it be called next year? Nobody knows, but this company owns a website called Gunbroker, which is very profitable, and they own an ammunition business, which is very shitty, and they lose money on it. And these guys are not good at running a manufacturing business, and they're not management I would trust anyway. But the main company has no debt, and they're getting $75 million for selling the ammo business to Olin. And if you have no debt and you've got $75 million in your pocket, and the remaining website that you have is very profitable and doesn't require a lot of money to run, and you're paying out a lot of money every year, 10.5%, I think it would be a good use of your cash to sort of call these in May of next year when they're callable, and pay the people out at $25 a share and go on with your life. So that's my thought on that. I do own some of this Ammo Inc. preferred. I don't own any LFMD. I don't own SRG preferred, and I'm not saying that you should buy any of these. That's just what I saw when I looked at it. This one, I think SRG, I'd have to wait for the company to either sell off everything and distribute what they have left to shareholders according to this priority, and hope that by the time they get to this tranche, there's some left for me. And there's no guarantee of that, and it's not a big dividend to take that risk. This one, you're getting a bigger dividend, and the company's not profitable, but it's looks like it may be profitable within the next year, so there's a better chance that this is going to be callable. And this one pays a little more, and they have a big chunk of money coming in if all goes well and they sell the ammunition business for the price that they said they would. But these guys are terrible in the ammunition business, and I think they're not great managers, and so I wouldn't trust them to to grill a hot dog competently. So there is some risk there, which is probably why this is $22 instead of $25 already. But yeah, that's my thought on these. And anyway, yeah, so I'm not technically a dividend person or a value person or a momentum person. I just like to find things that are cheaper than they should be. And I think if I have a spot in my portfolio for this, it would be in the Roth IRA for the tax reasons that I said. And I don't mind if it went up quickly, trading it out for something else. But I have a basket of things like this or Easterly government properties, which I mentioned, and some other things that I like in my Roth IRA so that I can sort of get that money tax free, which is worth more in the Roth than it would be in the traditional IRA or my taxable brokerage account. So that's my thought on that. And you do your own thing. Good luck on there. And if you have any questions, just leave them below. Thanks.